Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here are your daily technical analysis of foreign exchange market. I'll start with the euro against the dollar. A reactionary bearish dark cloud cover pattern yesterday as the market made it hard going trying to punch up once again through the declining long moving average, currently 104.03. Now prices pierced the congestion below between 103.38 to 103.69, but ended up closing within it. Further up beyond the long moving average, we have the February and March 2017 lows at 104.92 and the upper time currently at 104.94 of the broken but seemingly still influential January to May 2021 bearish Andrews pitchfork. This all highlighted once again the two recent core patterns we have here. We have a September to date ascending triangle and a September to date ascending wedge pattern, currently 98.67 to 101.85. I've highlighted the ascending wedge pattern in blue to show you a clearer idea of what I'm talking about. Both these patterns have had false breaks in both directions, which complicated things and compromised both patterns. However, both patterns have repaired themselves, and last Friday saw a clear break above the upper trend line of the ascending wedge pattern. So with all this action, let's now look topside and see what the remaining opportunities are for these patterns, or for the pattern. We have already seen the market reach and exceed the primary and secondary targets for the ascending triangle pattern, so these have been retired. We now have still live the possible targets for the ascending wedge pattern of a primary target X2 in the 105.35 area and a secondary harder to reach target X3 in the 107.65 area. So far today, a move up again towards the long moving average, but then a failure to engage. And prices have turned back down just on within the 103.38 to 103.69 congestion. Cable, aka sterling against the US dollar. For a long time yesterday, the action looked like it was going to be, to perhaps be, a significant daily key reversal down. However, in the end, yesterday was a less aggressive counter-to-the-counter bearish engulfing pattern, though for a while the market had pierced the upper trend line, currently 118.06, of the recent ascending wedge pattern. In the end, we had significantly another close above it. Much as in euro though, there are two core patterns here. I've highlighted the relevant trend lines in blue to help visualize what is going on. We have a late September to date ascending triangle, currently 114.38 to 115.06, and also a September to date ascending wedge pattern, currently 114.38 to 118.06. Both patterns have been previously compromised and both have repaired themselves. Late last week, there was a break higher over the flat trend line of the ascending triangle, giving possible targets for this pattern on the upside of a primary target X in the 120.20 area and a secondary harder to reach target X1 in the 122.5 area. This past Tuesday, the market managed to reach the primary target X before pulling back. We'll now see if there is sufficient bullish incentive to reach up to target X1. Meanwhile, with the consecutive close over the upper trend line of the ascending wedge pattern, it seems appropriate to lay out some possible upside targets for this pattern. Thus, a primary target X2 would be in the 124.20 area, with secondary and harder to reach target X3 in the 128 even area. So far today, small move higher based on, it seems, the lesser Fibonacci line at 118.59, but not breaking through yesterday's highs yet. Euro sterling. A second indecisive pattern yesterday, this time an indecisive spinning top to go along with the previous session's indecisive doji cross. Previously, I had suspected the indecision was due to two reasons: the support of the short medium moving average at 87.27 and the nearby 2021 high at 87.19, plus the nearby rising lower time, currently at 8700, of the breached but since repaired April to August bullish Andrews pitchfork. This latter support is perhaps the more serious of the two. However, as I said yesterday, the whole action for the last 3 weeks is beginning to resemble a possible roof pattern, sometimes called a half diamond pattern. We've not broken out of the pattern as yet, but that doesn't stop me laying out the size of the potential moves, both higher and lower. Thus, a confirmed break of the roof pattern downtrend, currently at 87.47, would see a primary target being 95 ticks higher, with a harder to reach secondary target 153 ticks higher. A confirmed break lower below the base in the 86.98 area would see a primary target 96 ticks lower and the secondary target 153 ticks lower. This is now the one to watch, as the downtrend of the roof meets the base by midweek next week. Now, so far today, a slightly lower opener, test down to the lower time and the lesser Fibonacci line at 86.98, but really still just holding on in there. Beneath that, we have the April 2020 low at 86.69, and then the slowly rising medium moving average, currently at 86.11. US dollar against the Indian rupee. A possible shooting star pattern yesterday after the previous session's bullish opening white Mariposa. It was also, incidentally, a fourth bullish white soldier. The market punched higher, reaching the declining short moving average, currently 81.76, which was seemingly enough to cap it. The base of the action was on the rising short medium moving average, currently 81.42, which earlier this week had been resistance. Looking below, we have further support at the recent 50% Fibonacci line at 81.13, whilst overhead, though pierced, we still have some resistance from the lesser Fibonacci line at 81.63. Now, before I go on to discuss the larger scenario, I want to spend some time on this shooting star pattern. A shooting star pattern, type 1, bearish, is a one-day bearish pattern seen at the top of a rise. A shooting star type 2 bullish is a two-day pattern that superficially looks like type 1, but when taking into account the previous session, becomes a bullish pattern. The past two sessions have elements of type 2, but not all of them. The key missing part is a gap between the sessions. But as this is FX and gaps are not that common, I'm giving this one some leeway, and thus looking at it as a possible type 2 bullish pattern. Okay, I need now to discuss the larger scenario, which I'd previously mentioned in my commentaries. So I highlighted the September to early November ascending expanding wedge pattern. Then late two weeks ago, markets or prices pushed down through the lower trend line, currently 83.61, and the move lower since then until the end of last week had confirmed that pattern. This gave a primary target in the 80.90 zone and a secondary harder to reach target X1 in the 80.28 zone. Last Thursday, the market reached the primary target, but we've since seen the market being shy of testing down through the rising medium moving average below, currently at 80.58, such that I'm now wondering if perhaps, just perhaps, reaching the primary target may have been enough. Now, this requires a little more contemplation and some further data over the next few sessions. So far today, a move higher, but still within yesterday's action, and halted once again by the declining short moving average. Beyond this, we have some recent congestion in the 81.94 area and a small congestion band between 82.15 to 82.26. US dollar against the Brazilian real. A third bullish white soldier yesterday, with a nice follow-on to the previous session's quite large hanging man pattern. Before I go into the overall picture, I should point out how long a tongue the market had on top. Extraordinary, with the highest high since January. Anyway, to the bigger picture. The market had snapped out of its recent indecisive reverie and closed for a second consecutive time over the upper time, currently 536.40, of the breached July to late August bearish shift pitchfork. This is on the edge of ending of its career as a capping pattern. Prices utilized the previous resistance of the lesser Fibonacci line at 538.13 for the move higher, punching up through the lesser Fibonacci line at 543.81, plus the July high area congestion around 550 even, and peaking at the congestion at 552.46 before heading back down to close below all of them. Looking below, we still have the 50% Fibonacci line of the May 2020 to April 2022 move at 527.37, which I continue to say does not look that good as support, though the other slightly lower 50% Fibonacci line at 522.76 of the March 2021 to April 2022 move does look a better support. I suspect the latter may be due to the conglomeration of moving averages nearby, specifically the short moving average, currently at 525.67, short medium moving average, currently 524.44, and the medium moving average, currently 524.55. Additionally, and this is now a big point, I had recently been very mindful of how the market last week almost set up this month for a monthly key reversal. The move up yesterday not only added to that idea, but has made it possible. Thus, if we close on the 30th of November either over 541.54 or under 517.91, then we'd be on. Right now we are looking at a possible monthly key reversal up. US dollar against the Mexican peso. A bullish white soldier yesterday, thus dispelling the indecision we have seen here since late Monday, and possibly turning this week into a bottoming action. Overall, the recent moves lower all relate to the previously highlighted crossover combination of the broken upper time, currently at 1956.33, of the March to July bearish Andrews pitchfork, and the middle time, currently 574.54, of the still intact bearish shift pitchfork for the same move. The market broke up through, but interestingly closed right on the recently broken support, which is now resistance, of the May low at 1940.70. 1940.70. Beyond this, we have the still influential 2021 low at 1953.63, whilst below, under this week's low at 1923.21, we have the March 2020 low at 1915.03. So far today, a move higher up through yesterday's highs, but not as high as yet as the 2021 low at 1953.63. Beyond that will be the broken upper time, currently 1956.33 of the March to May bearish Andrews pitchfork, which is where it all might start getting very interesting. Thank you for listening. This short version broadcast gives you essential market patterns and consequences. Please be aware there is a disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.